Howdy, Jacob here. Today we're looking at Corning Incorporated, ticker symbol GLW. So first things first, $26.1 billion market cap, $31.7 billion enterprise value. So about $5.5 billion in net debt. Currently a 3.66% dividend yield. So pretty close to that 4%. Let's look at how much debt that is relative to free cash flow. So about 7 billion in roughly 7 billion in long-term debt, and let's see, 1 billion, 1.8 almost, 1.8, 2.9. I mean, if you look at the last 5 years, it's probably a $1.5 billion free cash flow average, which is less than 5 times. So they have a good amount of debt, but not so much to be absolutely concerned about. Their payout of 977 billion. Like I said, about a 1.5 billion 5-year average. But keep in mind that the last 2 years, free cash flow has been down quite a bit, with rolling 12 at about a little under 500 million, and then 1 billion in 2022. But I feel like 977, just under a billion, should still be a reasonable amount. Looks like they have been increasing their dividend over 10% a year. I don't think they can increase at that rate. I mean, honestly, if they want to make acquisitions, buy back some shares, um, and then hopefully pay down a little bit more of their debt, they'll need to have a payout ratio that is probably pretty similar to what it is now. So I think that 977 million, I'm probably going to stick with that. No increase, no decrease. Just keep it at the roughly 3.7% dividend yield. And let's get into revenue growth and all that jazz. So 7.8 billion in 2013 to now 14.1. Um, there were a few acquisitions, definitely in the 20 teens here, 2013, 2014, 2015, and then it's lightened out quite a bit. But I'd say they got a good shot of 3% revenue growth over the next 7 years, and then at the end of that 7 years, they'll still have some growth potential. So I'll put them at a 13 P and price to free cash flow. Let's look at the average margins here: 7.5 and 12. Maybe let's assume 7 and 10 with a share change increase of maybe 2%. Let's go 1% because they did buy back shares, and then they've issued more recently. Let's say just a 1% increase. But with all that said, it still looks like it needs to fall 63% to give us a 15% return given these assumptions. I think I was conservative, but I don't think I was overly conservative. I think these are definitely fine first estimates, and so for me right now, definitely looks like an interesting company, but one that I is too far out of the price range for me to look into any further. So as of now, look into farther as of right now. So right now I'm just waiting. Thank you and have a good rest of your day.